Good morning, everyone, and welcome to the first in-person meeting of the IAG of this board. We're delighted to have you all here in Washington, D.C., so thank you all for coming. It's very nice to see everyone. Before we begin, I'd like to note our standard disclaimer that the views presented during this meeting are my own, and they do not reflect the views of the PCAOB board or staff. I'd also like to take care of a few administrative items before we begin discussing the agenda. First, if you need to speak, please tip your name card, and turn on your mic. We'll call you in the order in which the cards are raised. And there is a microphone for everyone. As a reminder, please note that this is a public meeting and it is being live streamed. I will now turn it over to Amy to say a few words.
Thanks, Saba. It's such a pleasure to be here today, finally able to collaborate in person with you all. Thank you for all that you do, Saba, in coordinating all the work of the IAG. You've been an incredible partner in this journey. And spending all the time endlessly speaking with each of us in order to facilitate productive discussion has gone a really long way into making us more efficient as a group. Thank you to the board for your ongoing engagement with the work of the Investor Advisory Group. We have been very hard at work to bring relevant and timely thoughts and discussion here today, as well as through our comment letters. And lastly, thank you to the members of the Investor Advisory Group. Your breadth and depth of knowledge and experience never ceases to amaze and inspire me. Thank you for your contributions to the important work of the IAG. And with that, I will turn it over to PCAOB Chair Erica Williams.
Thank you, Amy, and thank you, Saba. It is really wonderful to be here with you, and I am really grateful to all of you who've traveled to attend this first in-person IAG meeting. It's also nice to have those of you who are joining us virtually, and I really look forward to hearing today's presentations. Before we begin, I also want to provide the usual disclaimer that the views I express are my own and not necessarily those of the PCAOB board or its staff. Since we met last March, our dedicated PCAOB teams have been hard at work continuing to further our goals of modernizing our standards, enhancing our inspections, and strengthening enforcement. You will hear more about our progress today on modernizing our standards from Barb. Thanks to the hard work of Barb and her team, in March, we issued proposed changes to modernize a suite of standards that address core auditing principles and responsibilities, including reasonable assurance, professional judgment, due professional care, and professional skepticism, known as AS1000. The proposed changes will center investors by making clear that auditors have a fundamental obligation to protect them. Just yesterday, we proposed for a common and new standard on noncompliance with laws and regulations, or NOCLAR. When sanctions, fines, and civil settlements directly affect a company's bottom line or reputational damage causes a company's stock value to decline, investors pay a price. And the proposed new standard aims to better protect investors by strengthening the requirements for auditors to identify, evaluate, and communicate information that may indicate that the company's noncompliance with laws and regulations. Much of the proposal is informed by recommendations made by the former Investor Advisory Group in 2017. Your feedback will be vital as we continue to look forward to working, and we look forward to working with you to facilitate that dialogue during the comment period. Of course, we understand there is a direct relationship between the fraud standard and the proposed NOCLAR standard. Fraud is a type of NOCLAR. So the proposed NOCLAR standard would govern the evaluation and communication of fraud, and those requirements would be applied in the same manner as for other forms of noncompliance with laws and regulations. Still, our fraud standard, AS2401, consideration of fraud in a financial statement audit, would continue to govern the auditor's responsibilities with respect to the identification of information that may be indicative of fraud. And we continue to have a project related to AS2401 on our midterm agenda. So it's important to us that we hear from you today on both. And I am looking forward to hearing from our panel on fraud today, specifically getting your input on the approaches or methods other professions like forensic consultants, academics, short sellers, analysts, and analysts have used to detect fraud and how such approaches or methods to detect fraud might be applied in financial statement audits. As much progress as we are making on our standards, there's still much work to be done. In May, we updated our agenda, moving important projects up to the short-term agenda, including firm and engagement performance metrics, which I know is a priority for many of you, and adding new projects, including several rulemaking projects. At the same time, George and his team in inspections have also been hard at work. Our inspection division is the largest division at the PCAOB, and inspections are one of the most important tools we have to keep investors protected. George and his team inspect roughly 800 audits in more than 50 jurisdictions across the world each year. Of course, last year we expanded the PCAOB's reach even further by securing access to inspect completely in China for the first time in history. In May, we released the inspection reports for a firm located in mainland China and another firm headquartered in Hong Kong, which were both inspected in 2022. The deficiencies we found are unacceptable, and we are using every tool we have to hold the firms accountable for fixing them, including shining a light through our public reports and referring inspection findings to our enforcement team where appropriate. If enforcement violations are found, we will not hesitate to order sanctions, including imposing significant monetary penalties and barring bad actors from performing future audits. The fact that our inspectors found these deficiencies is a sign that the inspection process worked as it was supposed to. Of course, last year was only the beginning of our work. Firms in China and Hong Kong will be inspected on a regular basis going forward. Inspectors have begun fieldwork for China and Hong Kong for firms for 2023's inspections. We anticipate that fieldwork will continue off and on throughout the year, which is common practice for inspections such as these in jurisdictions around the world. The two firms we inspected in 2022 audited 40% of the total market share of U.S.-listed companies audited by Hong Kong and China firms, and we are on track to hit 99% of the total market share by the end of the year. We are continuing to demand complete access with no loopholes and no exceptions. Should the PRC authorities obstruct or otherwise fail to facilitate the PCAOB's access in any way at any time, the board will act immediately to consider the need to issue a new determination. As you know, enhancing our inspections is a key priority for the board, and we look forward to hearing your ideas today. We are committed to making our inspection reports as useful as possible for investors, audit committees, and others by including more information and getting out as quickly as possible. The timeliness of issuing the China and Hong Kong reports is just one example of how hard our team is working to speed up the timeline of when we issue reports. There is no question we have more work to do, and our staff started laying the groundwork last year by working overtime to clear out the backlog of reports from previous years. In 2022, the PCAOB issued 283 inspection reports, representing a 73% increase over 2021, and most of the reports have the most reports the board has approved in 1 year. That is no small feat, and it shows the dedication of our hardworking inspections team. Of course, our recent enhancements to the transparency of inspection reports is another important step forward, and this was just the first step, not a final step. We are continuing to look for more ways we can expand the information available to investors. But there is no question that shining a greater light on independence violations will provide new and relevant information to investors, and we thank members of the IAG who specifically flagged independence violations as information you would like to see included in the reports. It's worth noting that our inspectors have also uncovered a troubling trend in audit quality that many of you have heard me speak about, an increased number of Part 1A deficiencies. A third of the audits we inspected in 2021 had deficiencies of such significance that the PCAOB staff believe the audit firm failed to obtain sufficient appropriate audit evidence to support the opinion of the public company's financial statements or internal control over financial reporting. In December, I challenged the auditors to sharpen their focus and prioritize their efforts to increase audit quality and ensure investors are protected. We are working to hold firms accountable for improving audit quality by modernizing our standards, enhancing our inspections, and strengthening our enforcement. But we need your help. Encourage investors and audit committees to review our inspection reports and make use of their findings, especially firms that audit companies where they invest or serve on the board. Encourage them to take note of which firms are consistently complying with PCAOB standards and which firms are not. We continue looking for ways to improve the information we share and tools to help investors analyze that information. But we also know investors and audit committees can do a lot with what is already there. And that goes a long way towards pressuring firms to improve. In April, George and his team released a spotlight outlining their inspection priorities for the year, and it tackles the challenges we are seeing to audit quality head on. I encourage everyone to take a look at that spotlight if you haven't already. And finally, I cannot wrap up without mentioning one of our most critical ways we are holding firms accountable to improve audit quality, and that's enforcement. As you know, this board has committed to strengthening enforcement so that bad actors know that there are consequences for putting investors at risk. Last year, we imposed the highest penalties ever, and we doubled the number of enforcement orders from the previous year. And in March, we were proud to announce Bob Rice has joined us as our new head of enforcement. Bob has more than 30 years of white-collar litigation and investigations experience, including in the private sector, and a long history of public service in the government. He has hit the ground running, and his decades of experience holding wrongdoers accountable are already proving invaluable to our continued efforts to keep investors protected. Thank you for being here and for all the hard work you've put into today's presentations. And now I'd like to turn the floor over to Saba and Amy to get us started on today's agenda. Thank you.
Thank you, Chair Williams. We have a packed agenda, as you see it, that includes 4 sessions. First, Barb will provide an update on the standard setting agenda. We look forward to continued engagement with you all and receiving your comment letter on NOCLAR. After Barb's presentation, the IAG is presenting a discussion on CAMS. In addition to the discussion on CAMS, we'll also hear from 2 of the 4 subcommittees of the IAG. The subcommittee on standards will share some additional perspective on fraud, which is also on the PCAOB's midterm agenda. Followed by that discussion, the IAG subcommittee on inspections and data transparency will provide their recommendations to the PCAOB. So without further ado, I'll turn the floor over to Barb.
Thank you, Saba, and good morning, everyone. It's wonderful to be here with you today in person. Let me, too, give the disclaimer that my remarks today are my own and not necessarily views of the board, its members, or other PCAOB staff. Let me start with a little more on our May update of our standard setting and research agenda that Erica touched on. We updated our project on quality control and confirmations to reflect that the staff anticipate making recommendations to the board this year for adopting those standards. We also moved our project on substantive analytical procedures from the midterm agenda to the short-term agenda as we anticipate making a recommendation for a proposed standard to the board in 2023. In addition, we moved our project on firm and engagement metrics from the research agenda to the short-term standard setting agenda. Like substantive analytical procedures, we anticipate making a recommendation to the board this year. We continue to work with the board on all of the short-term standard setting projects, and the staff continue to make projects on the midterm agenda, including our fraud project. We're very much looking forward to hearing your input on that today. We continue to evaluate the interim standards, and as a result, we added a project on AS 2601, use of a service organization. We added that to the midterm agenda. That project would consider whether that standard should be amended or replaced to reflect changes in the nature and extent of how companies use services of third parties that are relevant to their own internal controls over financial reporting. We also added a project on interim financial information reviews to the midterm agenda, We would, of course, appreciate your input and perspectives on those projects. You will also see that we added a new section to the public agenda that addresses other short-term rulemaking projects that are beyond our professional standards. Those currently include 4 projects, one on contributory liability, which would consider changes to the board's contributory liability rule, which is our PCAOB Rule 3502. A project on firm reporting and transparency, which would consider changes to audit firm reporting requirements to the PCAOB, which would include periodic reporting requirements, special reporting requirements, and other enhancements to audit firm reporting. In addition, there's a project on registration, which, as the name implies, would take a look at our registration rules. And finally, one on follow-on disciplinary proceedings, which would consider amendments to our rules to provide for expedited follow-on disciplinary proceedings against registered firms or associated persons who have been convicted of certain crimes or enjoined or sanctioned by a court or another regulator. Next, I would like to provide an update on the board's most recent action on standard setting, which was the proposal issued yesterday for a 60-day comment period on noncompliance with laws and regulations. The proposal seeks to better protect investors from resulting harm when the effect of noncompliance that has a material effect on the financial statements goes undetected by enhancing the auditor's responsibility for the identification, evaluation, and communication of noncompliance with laws and regulations. The existing standard, AS 2405, was adopted by the PCAOB in 2003 based on a standard issued by the AICPA in 1988. It predates the enactment of federal securities law provisions that fundamentally altered the auditor's responsibilities for detecting and responding to illegal acts, namely Section 10A of the Securities and Exchange Act. Currently, AS 2405 states that the auditor's responsibility to detect and report misstatements resulting from illegal acts having a direct and material effect on the determination of financial statement amounts is the same as that for misstatement caused by error or fraud. However, it has few requirements related to the auditor's identification of noncompliance with other laws and regulations that have a more indirect relationship with the financial statements. One key aspect of the proposal is the elimination of this direct-indirect distinction. The proposal would require the auditor to identify those laws and regulations with which noncompliance could reasonably result in a material effect on the financial statements, without regard to whether that effect could be viewed as direct or indirect. The proposal would also replace the term illegal acts with noncompliance with laws and regulations. As with the existing definition of illegal acts, the proposed meaning of noncompliance with laws and regulations is broad. It would accompany any act or omission, intentional or unintentional, by the company whose financial statements are under audit, or by the company's management, its employees, or others that act in a company capacity or on the company's behalf that violates any law or any rule or regulation having the force of law. The proposed definition encompasses a wide variety of conduct, which would include everything from the embezzlement of company funds, misappropriation of assets, payments of bribes, as well as other conduct that has financial consequences to the company, such as violations of employment, occupational safety and health, antitrust, and privacy laws or regulations. Another important point to note is that the proposed definition would expressly include fraud, as described in the PCAOB standards, that is an intentional act that results in material misstatement in financial statements that are the subject of an audit. Importantly, while our standard related to fraud would continue to govern the auditor's responsibilities with respect to the identification of information that may be indicative of fraud, the evaluation and communication would be addressed by the proposed standard, and those requirements would be applied in the same manner as for other forms of noncompliance with laws and regulations. The proposed objective of the standards includes obligations for the auditor to identify the laws and regulations with which noncompliance could reasonably have a material effect on the financial statements, to assess and respond to the risk of material misstatement of the financial statements due to noncompliance with those laws and regulations, to identify whether there are instances of noncompliance with laws and regulations that have or may have occurred, and when the auditor identifies or otherwise becomes aware of information indicating that instances of noncompliance have or may have occurred, to evaluate and communicate those instances regardless of whether the effect is perceived to be material. Now I'd like to briefly touch on each of those objectives and the related requirements. So first, the proposal would strengthen current requirements by establishing an unconditional responsibility for the auditor to plan and perform procedures to identify laws and regulations with which noncompliance could reasonably have a material effect on the financial statements. The phrase "could reasonably have a material effect," as used here, is intended to allow auditors to tailor their plan procedures to focus on those laws and regulations that relate to the way matters are presented in the financial statements and the laws and regulations that may relate to the operations of a company with which the company's noncompliance could reasonably result in material penalties, fines, or damages. These laws and regulations would not necessarily be relevant to the company or its operations, but would not represent every law or regulation to which the company is subject. To facilitate this identification, the proposal includes enhanced risk assessment requirements for the auditor to obtain an understanding of the regulatory environment that would now include a proposed description of the nature and laws and regulations the auditor would understand as part of the audit, and management's processes related to identifying laws and regulations with which noncompliance could reasonably have a material impact on the financial statements. These enhanced procedures would be incorporated into the auditor's existing requirements to identify and assess risks of material misstatement in planning the audit. Next, upon identifying laws and regulations with which noncompliance could reasonably have a material effect on the financial statements, the proposal would establish an unconditional responsibility for the auditor to plan and perform procedures to assess and respond to the risks of material misstatement of the financial statements due to noncompliance with the identified laws and regulations. In addition to the procedures for obtaining an understanding of the regulatory environment and management's processes, we are also recommending more specific procedures that include obtaining an understanding of management processes related to preventing, identifying, investigating, evaluating, communicating, and remediating instances of noncompliance, receiving and responding to tips and complaints from internal and external parties regarding noncompliance, including those received through any whistleblower program that exists, evaluating accounting and disclosure requirements of noncompliance with laws and regulations, along with having the auditor make and evaluate inquiries to management, the audit committee, internal audit personnel, and others who might reasonably be expected to have relevant information. These inquiries and other procedures complement the existing risk assessment requirements and would focus on instances of alleged or suspected instances of noncompliance with those laws and regulations with which noncompliance could have reasonably have a material effect on the financial statements. The proposed inquiries would inform the auditor's initial assessment of risks of material misstatements, including those that are due to noncompliance. The proposal integrates these new requirements into the existing risk assessment standards to underscore that noncompliance could affect the risk of material misstatement and to help avoid any misperception that the auditor's consideration of noncompliance does not exist in a silo or be performed as a discrete step in an audit. In addition to these procedures, the proposal includes certain amendments that are intended to more broadly enhance the auditor's risk assessment procedures that we believe would have benefits to the audit, such as requiring the auditor to read publicly available information about the company, including information made available by the company and other sources external to the company, as well as information disclosed by the company's executive officers. The proposal's third objective is for the auditor to identify whether there is information indicating noncompliance with those laws and regulations with which noncompliance could reasonably result in material effect on the financial statement, and to plan and perform procedures to identify whether there is such information indicating noncompliance. Under this approach, the nature and extent of procedures that auditors would plan and perform would depend on the specific facts and circumstances of the engagement. The proposed amendments would require that auditors use information obtained from risk assessment procedures, including the new proposed enhanced procedures, along with other procedures performed throughout the audit, through reviews of interim financial information, and if applicable, the audit of internal controls over financial reporting. The amendments would underscore that the process for identifying information, again, that has been identified is not a discrete process, but is integrated throughout the audit. That's similar to the PCAOB's approach for fraud, and we think that that's an important enhancement to the standards. So when the auditor has identified or otherwise become aware of information indicating that noncompliance has occurred, we have recommended in the proposal that an audit objective, as well as the requirements for the auditor to communicate and evaluate such instances, regardless of whether the effect is perceived to be material or not to the financial statements. The procedures for evaluating and communicating information indicating noncompliance would apply equally to all noncompliance with laws and regulations. For purposes of evaluating information indicating noncompliance, the proposal sets forth requirements for the auditor to obtain an understanding of the nature and circumstances of any such noncompliance, and to determine whether it's likely that the noncompliance has occurred. The proposal establishes a threshold for evaluating noncompliance that is similar to the threshold for evaluation that currently exists in Section 10A, that requires evaluation when a firm detects or otherwise becomes aware of information indicating that an illegal act has or may have occurred, whether or not perceived to have a material effect on the financial statements. Under the proposal, the extent of procedures necessary would depend on the nature and circumstances of the matter, including whether the matter could be material, the relevance and reliability of information provided by the company about the matter, and the effectiveness of the company's process for investigating the matter. While the auditor would apply judgment to determine the nature and extent of those procedures, the proposal notes that inquiries alone are not sufficient to determine that noncompliance did not occur. The proposal does acknowledge, however, that inquiries alone may be sufficient to determine that likely noncompliance has occurred. Once the auditor determines a matter is likely noncompliance, the auditor would be required to determine the possible effects on the financial statements and the implications of such likely noncompliance on other aspects of the audit. The proposed standard provides a list of factors relevant to the auditor's determination of the possible effects, and these include the materiality of the likely noncompliance, the effects on the amounts and disclosures in the financial statements, including potential contingent monetary effects, such as fines, penalties, damages, and the adequacy of any financial statement disclosures. The proposal recognizes that some likely noncompliance may have an impact on other information accompanying the audited financial statements, and reminds auditors that they have an obligation with respect to other information under PCAOB standards. As such, the proposal includes a requirement for the auditor to perform additional procedures as necessary to determine whether the likely noncompliance results in other information in documents containing audited financial statements, or the manner of its presentation is materially inconsistent with information appearing in the financial statements or containing a material misstatement of fact. Additionally, the proposal would require the auditor to assess the implications of likely noncompliance on other aspects of the audit and to take appropriate action. For example, the auditor may identify new risks of material misstatements for a particular account or disclosure that are based on identified likely noncompliance, for which the auditor may now need to design and perform additional procedures. In the event that the auditor determines that likely noncompliance has a material effect on the financial statements, the proposal includes a requirement to evaluate the timeliness and appropriateness of the company's remedial action. There may be instances where remedial actions are ongoing and not completed at the time the auditor is expected to issue the audit report. In those circumstances, it is expected that the auditor would determine if the actions taken up until the time of the report's issuance are appropriate and whether the auditor's standard report is required to be modified. As noted earlier, we are also recommending enhancements to the auditor's communication to the company and to the audit committee related to noncompliance upon becoming aware that noncompliance has or may have occurred, as well as after the auditor evaluates the potential noncompliance. When the auditor identifies information indicating that noncompliance with laws and regulations, including fraud, has or may have occurred, the proposal would require the auditor, as soon as practicable and before the issuance of the engagement report, to communicate their understanding and nature of the matter and circumstances to the appropriate level of management within the company, as well as to the audit committee, unless that matter is clearly inconsequential. We believe communication takes place as soon as practicable when it is made in sufficient time to allow the recipient to use the information to take necessary actions. The proposal also recognizes that other audit participants, including other auditors and auditor specialists, may be the first engagement team members to become aware of noncompliance or fraud. These participants would be in the best position to bring that noncompliance to the attention of the auditor. Therefore, the proposal includes requirements of specific coordinated procedures and communications concerning noncompliance when auditors, specialists, or other auditors participate in the audit. These proposed requirements address two-way communication between the lead auditor and the other auditors or auditor specialists and are intended to improve the auditor's consideration of noncompliance overall. We look forward to engaging with you on this proposal and seeing your comment letter. There are staff contacts on the cover page, and we are happy to take questions at any time. Before I wrap up, I do want to note that we have a special guest today, and I want to announce that the PCAOB has retained Karthik Ramana as an advisor to provide recommendations and advice on standard setting, rulemaking, and research projects as we continue to pursue our ambitious standard setting agenda. Some of you may know Karthik, but for those of you who don't, he is a professor of business and public policy at University of Oxford's Blavatnik School of Government, and we're looking forward to him starting with us next month. We certainly look to benefit from his vast experience on corporate reporting and auditing. Karthik has joined us remotely, and we're eagerly awaiting his introduction. Karthik, would you like to say a few words to the group?
Thank you, Barb. Good morning, everyone, and thank you very much for the opportunity to join you today. As Barb mentioned, I'm a professor at Oxford, and for the last 7 years, I've also served as the director of Oxford's Master Public Policy program, where we've had the opportunity to educate 1,000 public sector individuals from over 100 countries now. My scholarship focuses on how trust is built and sustained in organizations and across systems, with interest in both informal mechanisms like cultural change, but also formal mechanisms like accounting and audits. And I'm very much looking forward to engaging with the various PCAOB projects. At least since Plato's Republic, we've recognized that every civilization must audit its auditors, and the PCAOB today plays that vital role in the United States and perhaps globally as well. I'm honored to be able to support this fantastic team on various initiatives such as the fraud standard and independence rules. I'll also share my perspectives on the effects of changes in the auditing environment as it pertains to standard setting, as I'm especially interested in the risks and opportunities of AI and climate change on the functioning of markets. Of course, I very much look forward to hearing and working with the investor community, so please don't hesitate to be in touch directly. Thanks again, Barb. I'll turn it back to you. Unfortunately, I can't stay for the whole programming because I have a full day of meetings, but I'll be around for the next few minutes, certainly. Thank you.
Thanks for joining us. I'll pause here to see if anyone has any questions. Oh, Hal?
Sorry, I'm sitting around the corner here. Barb, I pulled up the press release, I guess from yesterday, about the proposal, and what struck me about this is the phrase "non-compliance with laws and regulations," and I'm thinking back to just the banking industry and the tens of thousands of pages of compliance and rules and all the places that you could go wrong. I'm not certain any one individual knows all those areas. I mean, there are people who are dedicated to just pieces and parts across the spectrum. I'm trying to understand the scope, if you will. What is the actual scope? If I were on the audit team and I was going to, run the audit of a bank, kind of a mid-sized bank, would I have the skill sets? Would I have the knowledge of all those rules and regulations? Is there a way to kind of narrow it down for us?
Sure, I'm happy to start, and Jessica, you can jump in after. Jessica here was part of the team that led the project. When we talk about those laws and regulations with which non-compliance could have reasonably have a material effect, as I said, it's not meant to be all the laws and regulations. In the release, there's a discussion, and one of the examples we give is that the auditor could obtain knowledge about which of those laws and regulations to focus on by looking at company disclosure. Companies are required to disclose laws and regulations that could have a material effect. We do note that that might not be the whole population, but we do think that that's an important piece of information if you think of this as kind of a funneling of all of the laws and regulations.
And how would I assess that material effect? I'm thinking of one bank who, had some issues with fees and ended up paying billions of dollars in fines. Clearly had a material effect, but I wouldn't know that at the time of assessing, certain compliance for opening and closing accounts, for example. And I'm just using that as an illustration. So I'm struggling a little bit with how we're going to narrow this down. So I'll be very interested in all the feedback you get over time. I'm sure we'll get a lot of feedback on that. But I didn't know if you had any additional thoughts. But it seems like this is a work in progress at this point.
Well, I mean, we certainly want to see what commenters have to say. That was the way we approach scoping in the standard. And in some cases, we do see firms do work on this kind of thing today.
Yeah. I like the notion here. I'm just concerned about how wide of a net we're casting.
Are there any additional questions?
I have one question. You mentioned generally when we discuss these matters, materiality is kind of an important threshold. However, you sort of mentioned that there is a potential obligation if fraud is detected and it is not material. Is it still required then to be communicated?
Yes.
Jeff?
Morning. Thanks for that update, Barbara. Appreciate it. I guess a couple questions and then a request. My questions are, from the investor perspective, can you point to like the top 2 or 3 provisions or paragraphs in the document that you think are most important for investors?
That's a tough question, Jeff. I mean, I would certainly defer to the people at this table for determining what's most important to investors. I personally do think the scope of the standard is important, along with the proposed elimination of this direct and indirect. As you can see from our speaking points yesterday, we pointed out that financial statements need to be free from material misstatement, whether due to error or fraud, and that could include non-compliance that was not recorded or disclosed in error or intentionally not disclosed.
And from the perspective of the industry, what do you think the top 1 or 2 issues would be? I suspect scope may be one of them. Is there another one?
I think we'll just have to wait and see.
And my request is you held a session for the committee following the release of the prior proposal. That was very helpful I want to speak for Jack, but I think it was very helpful for Jack in drafting the committee letter, and we'd really appreciate it if you could do that again once. I haven't read the proposal, and I'm sure some others on our group haven't yet either, but I'd appreciate it once we get a chance to read the proposal that you're able to do that again with the group, because it was very helpful.
Happy to do that. Thank you.
Thank you.
To what extent are there learnings or post-implementation work, and I don't know this, I could look it up, I was just quickly looking on the application of NOCLAR in the international context, right? To answer Hal's question, for example. I don't know if there's been any, I know they've adopted it, but I'm not sure if there's been any post-implementation reviews that would help inform us in responding to sort of how these have been implemented and what's worked and what's not. I don't know if you know anything, or I can take that as a follow-up for myself.
We're happy to take a look, but I don't believe that we found any in our research.
Okay.
Are there additional questions for those who are on the Zoom session? Do you have any questions? Amy?
Thanks, Saba. Barb, that was fantastic. We have really enjoyed all the collaboration we have benefited from with you and your team. So we look forward, as Jeff just asked, to doing that on this important piece of work that you have just put out. I know there are some members of the IAG who are critical in providing past IAG research on this topic, so I'm sure we'll have some opinions to share with you. So thank you very much for that. Next on the agenda is the IAG's presentation to the PCAOB Board on Critical Audit Matters, or CAMs. The panel includes Colleen Honesberg, Marty Bowman, Samantha Ross, and Jared Goodman. Sandy Peters, a member of the IAG, is moderating today's discussion, and we have provided bios of all the speakers in the agenda. The discussion today will provide an opportunity for the board to hear diverse perspectives on CAMs as we continue to look for opportunities to increase compliance and help stakeholders understand the purpose and investor expectations. Today's panel is stocked with experts who will help us understand the history of CAMs, how they have been implemented, and potential considerations moving forward. With that, I will hand it over to Sandy Peters.
Great, thanks, Amy. At the last, I never get the pronunciation right. Is it SEAG? The Standards and Emerging Issues Advisory Group. The PCAOB staff provided that advisory group with an update of their post-implementation work related to the inclusion of critical audit matters, or CAMs, in the audit report. A video of that session is on YouTube if people want to take a look at it. That discussion, combined with recent attention to CAMs as a result of several high-profile bank failures, have drawn attention to whether CAMs have achieved what was originally expected of them. Because of this, we thought it would be worthy of our time to have the IAG discuss whether CAMs have met the expectations of investors and to consider what may be necessary in enhancing the disclosure of CAMs to meet investor expectations. So as Amy said, that's really our objective today. One of our speakers will provide more detailed background on the CAMs, but just a couple of introductory remarks. The PCAOB finalized the revision of the auditor's reporting model in June 2017. Those revisions included not only critical audit matters, but disclosure of the auditor tenure, a statement regarding the auditor's requirement to be independent, changes to the addressees of the audit report, the presentation of the auditor's opinion being in the first paragraph, and changes to other basic elements of the audit opinion. The revisions other than CAMs were effective after December 15th, 2017, or December 31st, 2017 for calendar year companies. CAMs, however, weren't effective until after June 30th, 2019 for large accelerated filers. So December 31st, 2019 for calendar year filers. And for all other companies, after December 15th, 2020, so December 31st, 2020 for all calendar year companies. I always hate that, the calendar year versus the fiscal year. So my point of reiterating what those dates of adoption were is because we've now had 3 to 4 years of CAM reporting, so 2019, 20, 21, 22. And during those 3 to 4 years, we've seen the adoption of the new leasing standard, the new credit loss impairment model, a pandemic, inflation, a historic rise in interest rates, and the recession, which everyone keeps predicting but doesn't seem to come completely. The question, and all things which should impact significant estimates and judgments within the financial statements and the underlying audit work associated with these events. The question is, have we seen these manifest into changes in CAM over time? Prior to these 6 revisions to the auditor's opinion, the audit opinion was boilerplate, pass-fail, and nothing more about the audit or the auditor's work. Yet investors were asked to affirm the audit committee decision regarding the retention of the auditor in their annual proxy vote. The question for investors as the client of the audit firm is, what information do we have to evaluate auditors' work and cast our vote? This is really sort of what started the discussion of CAMs. I went back to the Wayback Machine and looked at CFA Institute's surveys on this topic from 2008, 2010, and 2011. And I don't know how the slide deck. So there were 2 really interesting questions in the 2008 surveys, predates me at CFA Institute, and 80% of the approximately 1,500 respondents said that auditors should provide information regarding how the auditor reached their unqualified opinion. And then, that's shown on this slide, then on the next slide, we asked them about 6 key items. Do they want disclosures about key risks, the impact of changes in key risks, items with a degree of measurement uncertainty, materiality, changes in accounting principle, or auditor tenure? The first 3 related to audit risks and measurement uncertainty were really what were most important to investors. Materiality and auditor tenure were less. So it really gets to the question that we raise about, have risks changed over this period of time? So that's what we're going to sort of take a look at today. You'll also hear, and I'll let Marty go through this, the terms CCAMs and KCAMs, and CCAMs being the U.S. critical audit matters and KCAMs being international, but I'll allow him to go through those distinctions. So we have, as Amy mentioned, we have 4 speakers. Marty Baumann, who pretty much needs no introduction because he was the chief auditor during the creation of the auditor's reporting standard. Prior to that, he was at Freddie Mac, the chief financial officer at Freddie Mac, and a partner at PwC. He'll go first and give us more of the background I sort of just gave some introductory comments to. Then we have Samantha Ross, who'll provide us some context and anecdotal observations since the adoption of CAMs. She too worked for the PCAOB as the first chief of staff and supported various of the chairmen, Chair McDonough and Doty, as well as served as a member of board member Neumeyer's staff. So she's been involved heavily in the adoption of a variety of things over the PCAOB's tenure. And then we have Colleen Honingsberg, who's a professor at Stanford. She's not only a PhD, but a CPA in California and a lawyer in New York with some pretty impressive academic credentials. And her research focuses on corporate and securities law. And we not only read about it in academic research, but in our mainstream financial journals. I didn't realize until we did this, she was also a fellow at the PCAOB in their economic research department. Finally, we have Jared Goodman, who's going to provide an investor perspective, and Jared's a senior portfolio manager at Colorado Employees Retirement Association, where he manages a $2.5 billion small and mid-cap portfolio covers industrials and healthcare. And prior to that, he was an equity analyst at UBS, and he worked at KPMG focusing on internal controls. And I didn't know until reading his bio, he's the CFA charter holder. So that's good. As my husband would say, you know the secret handshake. So with that, the next slide is just sort of our running order, our agenda for the panel, which is I'm just giving the objective. Marty's going to go through the background and history of CAMs. Sam's going to go through anecdotal observations. Then we're going to get comments from Jared on investors, the academic research. Then we thought we'd open it up to the investor advisory group for questions and comments on what's been said, and then wrap up with some suggestions and way forward. So that's our plan for today. So with that, they put me in front of you guys so I could drill you from over here. Let's start off with Marty, giving us a bit more background than what I've given you.
Great, thanks, Sandy. And I also wanted to thank the IAG in general for having this important session and the board for inviting us here and be as part of the IAG. And I wanted to express my appreciation to the board and staff for the great work that you're doing. A lot of great things are happening at the PCAOB, so I'm glad to see that. Strangely enough, I'm going to make a disclaimer, which is kind of odd. Usually somebody presenting doesn't do that, but I may, as was mentioned, I was the chief auditor during the development of the audit reporting model standard and CAMS. So I may say things along the way like, our expectations were this or whatever. I'm speaking for myself when I say that, and I'm not speaking for the board in any fashion. Anything I express today are my views and not the views of a past board or a current board. It's my views. So Sandy gave a little bit of the background and the history of CAMS, but let me continue on that. The PCAOB, because of a lot of the slide that Sandy put up, the PCAOB initiated the audit reporting model. Investors were saying that we get the audit report, the opinion from auditors, but that's all we get. And we really don't even look at the opinion because the opinion doesn't change from one company to the other. It's a standard boilerplate opinion, and there's nothing in that document. We may look at it to see who the audit firm is, but that is the only reason investors said they looked at the then current audit opinion. Investors felt the audit was valuable, so they appreciated the audit, but they just weren't getting much from the auditor themselves in terms of the content of what the auditor learned during that audit. So they really wanted to hear more about that. Not all financial statements are the same. Not all judgments made are the same by companies in similar circumstances. Yet the boilerplate opinion gave no insight whatsoever to different challenges auditors might face at company one versus company two, even in very similar circumstances. The mandate, of course, of the PCAOB is to protect the interests of investors through informative, accurate, and independent audit reports. I think a lot of work was being done under standards of the PCAOB and the SEC around independence, certainly around accurate audit standards and inspections, and the role of the PCAOB were working on that. But the informative aspect of the report, it really was missing. The audit report simply was not informative. And so the ARM project and CAMS were intended to meet that objective of making the audit report more informative and meeting those expectations of investors. As I said a minute ago, financial information is prepared by management who have inherent biases. It's discussed in academic research over and over. There are inherent biases by management, as even honest management trying to do a good job have inherent biases in the estimates they make. And as we all know, financial statements are essentially just a compilation of a lot of estimates. There's really no number in the financial statements that's a pinpoint number. So in arriving at all of these estimates on the financial statements, they're very subjective, complex judgments involved by management, and the same by auditors. Auditors, in evaluating all of these complex estimates in the financial statements, have to go through a process of assessing how reasonable those different judgments and estimates are. And they can be, those estimates, on a wide spectrum of reasonability. And so we hear the term a lot about measurement uncertainty. Many of the estimates have very wide degrees of measurement uncertainty. In some cases, can be wider than net income itself. Wider than materiality, or measurement uncertainty can be wider than net income. And so investors said, tell us about these complex financial statement matters and the very challenging matters and how you address them in the audit. And that's really what they asked us at the PCAOB at the time, and we're asking of auditors. But yet they were getting the same audit report over and over again in every company. So that's what investors wanted. They were really looking for much more in the audit report. They were looking for, in some cases, as was shown here on the slide that Sandy had up, some analytical information about the company itself. Now, management's, well, first of all, the ARM project was an extraordinary challenge. Managements, boards, audit committees, law firms of companies, et cetera, were not supportive of changes in the audit report. They felt that anything about communication about the financial statements was purely the prerogative of management, and that auditors shouldn't be saying anything further in the audit report about the financial statements. Their perspective about the quality of the financial reporting, which is what investors wanted to hear about, managements and boards, and their comments back to us at the PCAOB at the time, was that is not the prerogative of the auditor, that is management's job. But even auditors at the time said to us, in talking about the qualitative aspects of a company's financial statements, there's no guidance. There are standards for doing an audit and expressing an opinion, but there's no guidance for saying, well, if the quality of this particular set of financial statements an A or a B or a C, or however we might want to communicate qualitative aspects, there's no standards for that. And so we really wouldn't know how to do it. And you run the risk that Auditor A and Auditor B, or Auditor 1 and Auditor 2, looking at very similar companies, very similar situations, might rate those qualitatively different. So you might be actually doing more harm to investors than good. So auditors themselves opposed the audit reporting model insofar as they said, if you want us to talk about the financial statements, that's a serious problem. We agree it's management's prerogative, and we don't think there are any guidelines and standards for us to do that. So at the end of the day, after much research, it was a very lengthy project. After much research, outreach, discussion documents, et cetera, with the public and comments back, we came upon the view that the best thing for the auditor to do was to talk about the audit in the audit report and to talk about critical audit matters, those matters that the auditor felt were especially difficult and challenging. So a moment ago, I said, of course, that management faces all of these challenges in preparing financial statements. Every single decision they make around financial statements is a judgment, an estimate. And auditors then have to assess those very complex decisions and make their own set of complex decisions and judgments. And so critical audit matters were then the outcome of what we said auditors should talk about. So next slide, please. And so critical audit matters were created as part of this and proposed, and ultimately critical audit matters were adopted as a critical audit matter is any matter arising from the audit of the financial statements, and I say that again, any matter arising from the audit of the financial statements that was communicated or required to be communicated to the audit committee, and that relates to accounts or disclosures that are material to the financial statements, so related to matters communicated to the audit committee about material accounts or disclosures, and involved especially challenging, subjective, or complex auditor judgment. The word especially was added there. We thought of the word most challenging, thought of a variety of words. If it just said involved challenging, subjective, or complex auditor judgment, auditors would say, that's every single thing we do. Every single procedure on every single matter, whether it's inventory, receivables, deposits, loans, everything we look at involves challenging, subjective, or complex auditor judgments. So we had to modify that in some fashion. So especially it was there to say, okay, so this is the more challenging, subjective, or complex auditor judgments that you'd be facing. So that was the definition of critical audit matters, and is the definition. And at this point in time, the auditors who didn't support commenting on the financial statements were supportive of, in general, were supportive of changes to the audit report to include critical audit matters. Next slide, please. So just to show you, and not to read this whole slide, but this includes some of the many things that auditors are required to communicate to audit committees. You know, we all hear, and many of you are on audit committees, and So we all know that conversations between auditors and audit committees are pretty substantive conversations. Matters included, that are required to be included by the auditor in the audit committee reports, and there are many usually during the year: significant risks, critical accounting policies, significant unusual transactions, the qualitative aspects of the company's accounting, just what investors sort of wanted to know about, assessment and conclusions regarding critical accounting estimates, the clarity of the financial statement presentation, matters consulted outside the engagement team, specialists, et cetera. When an auditor employs the specialist, let's just think of an oil company, to understand about reserves, that's not something that's in the auditor's skill set. They hire geophysicists and engineers, et cetera, the company does, and so does the auditor, to give them information to enable them to audit those complex things that are outside their expertise, like a gemologist with respect to the value of a gem. Those matters, by definition, are matters that would be especially challenging for an auditor because it's outside their skill set. They need specialists. And they often go to their national office or industry specialists to get assistance on very complex matters, corrected and uncorrected misstatements, et cetera. So really anything important, this is not an entire list either of what's required, anything important is required to be communicated to the audit committee. Next slide, please. Then the standard also included in it a non-exclusive list of factors that the auditor should think about and saying, okay, among all of the things communicated to the audit committee, here are some things you should think about as you think about the more challenging ones, the especially challenging ones. Your assessments of risks, significant risks, the degree of auditor judgment, measurement uncertainty, unusual transactions, the amount of effort that you employ, the extent of specialists you use, and all of that. So the nature of audit evidence. So a lot of guidance was given to auditors and how they would get to these judgments. Next slide, please. In addition to that, the standard required documentation of critical audit matters by the auditor. So the reason I put this slide up is so you think about this. A lot of matters are being communicated to the audit committee. So not necessarily every one of those matters was going to be a critical audit matter, but the expectation was that some good subset of matters communicated to the audit committee would be then disclosed by the auditor as critical audit matters to investors. And so we required the auditor to document for every matter that was reported to the audit committee and related to accounts or disclosures that were material, document whether or not that matter was determined to be a critical audit matter and the basis for that determination. So if you communicated something to the audit committee that met the, related to material items, did you communicate it as a CAM, yes or no? If you didn't, what was your rationale that you did not? So there's a roadmap there for inspections, et cetera, to look at. This has been still yet a challenging implementation by the auditors, as was mentioned by Sandy. 3 or 4 years have gone by. During this time, next slide, please. During this time, the PCAOB staff have issued quite a lot of guidance. They've done, I think, an excellent job in clarifying things in the standard or amplifying what the standard meant in certain cases. From reviewing the audit methodologies of firms to the basics of the standard itself, to a deeper dive on the determination of CAMs and a deeper dive on the communication of CAMs. And one of the things here is the deeper dive on the communication of CAMs, that among other things, the guidance, this is from the staff guidance itself, makes clear is that the word especially was chosen instead of most, as originally proposed, to convey clearly that there could be multiple CAMs. There was no expectation that this was a, one critical audit matter. Next slide, please. So briefly, I'm just going to mention the outcome to date, but we're going to get into a lot more of this as the other speakers on the panel here comment in a second. Academic research, Colleen will go over that, but it's somewhat limited to date. But we've learned certain things that are really important. research has shown that there are about 1 or 2 CAMs disclosed in large firm audits. That probably is not the expectation from all of the guidance that was given and what investors asked for and what the PCAOB has come out with in terms of clarification in terms of determining CAMs. So 1 or 2 in large firm audits. I've looked at many audit reports of some of the largest and most complex companies from banking to energy to other industries and seen 1 CAM in many cases, or sometimes 2. I did see an insurance company that had 3 CAMs. Some research has shown that auditors are deriving comfort, and they're getting comfortable that, well, if one firm is disclosing 1 or 2 CAMs, then I guess we're comfortable doing that. That was an academic study led by Griffith, et cetera, in terms of interviewing a lot of audit firms and the level of comfort they're deriving from disclosing what others are. So the real question we want to explore today is this meeting investor expectations? And Sam, Colleen, Jared have more to say on this, and then I'll be back a little bit more to talk with some more views. So I'll turn it over to Sam at this point.
Great, thank you. Do I need a different machine here?
Here you go.
Okay, great.
Can I pause for a second?
Oh, sure.
Hal wants to ask a question, so.
Sorry, Marty, in those early discussions, and I remember being part of the SAG at that time when this was on the agenda and being discussed, we talked a lot about what the auditors and the companies thought about this, but was there consideration given to educating investors about some of the points that you made about virtually everything on the balance sheet as an estimate? That's the one thing I didn't hear in this process, is was there a plan to educate investors before they started to consume the information that was to come out of CAMs?
I don't think that was part of the PCAOB's particular education. I think that's comes out of FASB, where you were before, where hopefully educating investors about the complexity of whether it's revenue recognition or depreciation or anything else. It's an estimate, and there's really nothing on the financial statements that is pinpoint, probably not even cash, that everything is an estimate. So I don't think there was a particular education about that. There was education about how subjective things were, and management's determinations were complex, involved a lot of judgment in deriving at their financial statement numbers, and auditors therefore needed extensive judgment as well to audit those matters because there was wide degrees of measurement uncertainty, et cetera. I don't think that was specifically part of the PCAOB's outreach, however.
I agree with you on the accounting aspect of it, but the audit, I think that was just a wide misunderstanding. Many investors think that you do a test of every single transaction or an evaluation of every single transaction. They don't understand the audit process in general. So I know Sandy wants to keep us going.
Yeah, no, but I would say something there. In 2014, I wrote a paper about forward-looking information and estimates because we were going through this process. And Larry Smith was at a SAG meeting, and he went through and listed out every single place where there were estimates and forward-looking information in the financial statements, because we were getting some of that sort of like, do investors understand, does forward-looking information belong in financial statements? So at the time, the PCAOB, maybe not necessarily, but we were trying to address that. I just put that out there, yeah.
Great, okay, thank you. I guess I should give the same disclaimer that Marty gave as a former staffer. I want to thank Amy and Saba as co-chairs of the IG for inviting me here today. And I also want to thank Chair Williams and the board members for inviting me and being here. It's just fantastic to see my former colleagues and many new staff so actively engaged in such meaningful initiatives. So thank you. I was, as Sandy discussed, I was on the staff of the PCAOB when the PCAOB adopted and then the SEC approved auditing standard 3101. At that time, in 2017, Chairman Doty said it marked the first significant change to the standard form auditor's report in more than 70 years. And as Marty described, the intent of this change was to make the auditor's report more relevant, more useful, more informative, and essentially to breathe new life into a formulaic reporting model. I think it was understood at the time, by the way, that AS 3101 was a first step to bring narrative insights into the audit report and put experimentation in motion. And actually, to Hal's question, since I left the PCAOB, I do spend a lot of time with investors, especially on education about the audit. I think that's very worthwhile because it is sort of a black box to investors. So more education is definitely a good idea, but that's what I do spend a lot of my time on. And in that connection, I read a lot of audit reports, both here in the U.S. and outside the U.S. I agree with Marty's concern that there are surprisingly few critical audit matters in the U.S. audit reports, and I'm disappointed to see they've even decreased over time. What I'd like to do today is focus on some examples of what investors can, and in some cases are, getting from CAMs, critical audit matters, and what investors find confusing. First, I do think that CAMs provide useful information, some CAMs at least. Even the sparest of CAMs typically at least describes the auditor's approach to a critical issue, which often involves choices. I've seen CAMs that explain that the auditor chose to use an expert hired by management to test significant accounting assumptions, for example. And I've seen other CAMs in which the auditor used its own specialists to develop assumptions to compare to management's. Understanding auditors' choices gives investors an opportunity to make judgments about the quality of the audit, and that's important. I've also encountered amazingly robust audit reports, which to my mind shows where the future of auditor reporting can go. Admittedly, the most robust have been on non-US companies' financial statements, citing the international standards. But it's not the standards that are dictating more or less robust discussions. It's the level of specificity. The level of specificity is itself a choice. I hope the existence of some truly fantastic examples will motivate others with your the committees and the PCAOB's encouragement to be more expansive. And in this regard, I'd like to describe first the auditor report on Glencore PLC's 2022 financial statements. Now, it's 16 pages, so I'm not putting it in front of you to read now. Happy to provide it afterwards. 16 single-spaced pages for the auditor's report. There are 6 key audit matters. They're called key audit matters under the international standards. And those 6 key audit matters consume 9 of the 16 pages. Those 6 CAMs relate to government investigations and related claims, impairments of non-current assets, potential impact of climate change, again on non-current assets, classification of trading contracts and arrangements which contain a financing element, marketing revenue and fair value measurements, and tax issues, including uncertain tax positions and deferred tax assets. What I noted about that audit report is that the auditor's observations, which they did include observations, often related to the adequacy of disclosures relating to whatever the specific topic was in the CAM. And they looked at they discussed whether those disclosures, often in the footnotes, are appropriate in accordance with the accounting standard at issue. As I understood, one concern expressed during the rulemaking process, when we were staff here, was about the option to discuss observations relating to CAMs. Marty touched on that, and that was the concern was that it might come across that the observation was somehow itself an independent, separate opinion. I think it's clear from these examples in the Glencore report that the observations are not separate opinions, but rather helpful matters of emphasis. In the discussion of the second CAM on impairment of non-current assets, the report lists numerous steps the auditors performed, using terms like challenged and potential contradictory evidence, and explicitly discussing the risk of fraud and management bias. The auditors included several observations relating to this CAM, such as why they felt that the key assumptions used in impairment testing were reasonable. The report also says that notwithstanding our conclusions about the reasonableness of the company's impairment testing, we found that the level of management review and the documentation retained relating to certain judgments and key assumptions that were in the company's complex models requires improvement. The report then goes on to say that the auditors considered this finding about the need for improvement in its audit response. So I'm sure this is not what management wanted to hear. And it must have been the subject of some robust and perhaps even tense discussions with management and the audit committee. But what I take away from it is that the auditor is truly independent. This increases my confidence in the reported asset values. That's the whole point. As I mentioned, the third CAM is on the impact of climate change on the company's current financial results and position. And this can happen in a number of ways. For example, by affecting estimated useful life of long-lived assets, a very basic accounting concept. Changes in estimated useful life can affect current depreciation in today's financial statements, as well as, for example, the present value of asset retirement obligations that are, again, on today's financial statements. The CAM discusses these effects and draws special attention to the note to the financial statements that details the accounting measurements and disclosures that are most impacted by climate change and Glencore's climate commitments. Now, it's possible the company would have provided that disclosure anyway, but the reference to the footnote makes clear that the auditor scrutinized the footnote for accuracy, clarity, and completeness. That's what you'd expect with a matter that is especially critical, as Marty was describing. The CAM goes on to make an observation about the company's assumptions about future commodity prices. Now, these are the prices the company comes up with to estimate future cash flows to test for asset impairment. The report says the company's assumptions were conservative or below relative to broker consensus ranges. That's helpful for any investor or analyst to know. It builds confidence in the financial reporting. It tells investors that the company didn't use aggressive hidden assumptions to meet targets or avoid having to acknowledge an impairment. I could go on, but again, as I say, the CAMs take up 9 pages. There's 6 CAMs taking up 9 pages. There are so many things I like about this audit report. It doesn't just say that the auditor was independent. It demonstrates it. It makes clear that the auditor was highly expert, thought through every risk that could have a material impact on the accuracy of the financial statements, and turned over every stone necessary to address those audit risks. More broadly, I come away from the Glencore audit report with a much deeper sense of confidence in the company's reporting and a palpable feeling of trust that the auditors focused on important issues and methodically nailed them down. The audit report on Glencore's financial statements clearly addresses one of the most fundamental problems facing dispersed capital markets: the information asymmetry as to whether a company's financial claims are reliable. Put simply, this audit report doesn't just say the company's financial statements are fairly presented in conformity with the applicable accounting standards. It explains why the auditor is so confident about that. And the Glencore CAMs are quite specific. They clearly apply to this audit of this company's 2022 financial statements. No one could say they're boilerplate. Now, this kind of robust audit report was a choice. Nothing in the non-US standards forces auditors to write more robust audit reports than those we see here in the United States. But I will say that the perceived differences in US and non-US standards are causing confusion. These differences are most apparent in audit reports on dual-listed companies. They're apparent. We can see the differences. Investors find it confusing when some, we'll call them KCAMs, key audit matters, in the non-US version do not appear in the US version. And it's disappointing when those missing CAMs are actually rather useful. I've also seen situations where there are K and C CAMs in both reports for a dual-listed company, but the C CAM is shorter. Some sentences are not there that were in the other version. It erodes trust when investors think they need to check a company's home country disclosures to obtain important information that doesn't show up in the US version of the audit report. And it erodes trust when investors have to wonder what they may be missing in the US only context when they don't have another report to look at. So I really commend the committee, Amy and Saba, everyone else here, our friends online, our dear friends in the UK, David Pitt-Watson and Karthik, I see on the screen. I really commend you for looking closely at the question whether our capital markets are getting all they can out of CAMs. I think the CAMs are really the key to the success of the future of the audit, and there's a lot more that we can see. So I look forward to the discussion.
Sure.
Sam, thank you, and I pulled up the 16-page
Yeah,
report, starting on
great.
starting on page 141.
Yes,
if
it does.
You're looking for it.
And it's where you should start when you're reading that.
Yeah. And this is very much what I had envisioned when we started
Yeah,
talking about this
right.
15, 20 years ago. Is this an outlier? And I'm sorry for not knowing this, and maybe
Yeah. Mm-hmm.
Colleen will, so this is truly an outlier.
Look, these are my views. In my view, I read a lot of audit reports. I haven't done a systematic study. I'm looking forward more to what Colleen's got to say. But yeah, I'm showing you what a really great report is. This
Okay,
is
I didn't know if
the
there-
gold
If it
standard
were
we should all shoot for.
one by itself, or there were 20 others,
So
reason
in
I asked this,
general, go ahead.
I'm going to ask for just some background here. This is one of the big four firms that signs off on the report.
Yes.
What led them on this particular audit to get there? And maybe this is more of a question for Colleen. I don't know if it's covered in any of the research. But I'd be curious as to why in this report, we ended up with a 16-page and virtually no other report has anything nearly as robust.
Yeah.
Even though this is one of the big four firms.
That's the big question.
Okay,
That's absolutely
fine.
the big question. And we'll say, yeah, this was an outlier, but on the whole, the non-US reports do say a lot more. I mean, I could give you many other examples of very good non-US reports. One thing, so one thing that gets said a lot is, oh, the standards are different. And the standards are different, but they're not that different. And like I said, it's confusing when in theory, yes, there could be a KCAM that doesn't satisfy the definition of CCAMs. But when I look at the differences that I see, at least in the dual listed companies, so that's the only thing you can actually see, I don't get it. A lot of most of those KCAMs, to me, have a pervasive impact on the financial statement line items and qualify for the definition. I mean, I don't know if they were discussed with the audit committee, but Marty gave you that list. It's a very complete list. So I would be shocked if those things were not discussed with the audit committee. So
And
I don't
just-
think it's the standards, like I said. I think it's something contextual, environmental. That's the thing we need to really,
The other thing
get
I'd be
underneath.
very curious about, and this is more for the staff, is what's the incremental cost of this versus the 1.5 page or whatever it is? What was the
Right.
incremental cost? And I'd love to know the discussion that occurred to why are we
Right.
spending this additional money?
so great question. This report was signed by, as I read it, an auditor who is at a Big Four firm, but in the Geneva practice, at Geneva, Switzerland. I don't know that we have access to those costs, especially the differential costs probably wouldn't show up. But one thing I would say is if you're looking at the costs, I mean, I think the auditor's in Switzerland, but the
It's
actual
still
auditor.
signed off London.
Yeah, by a specific,
Oh, but the
Person.
auditor, I
Yeah.
don't know, okay.
yeah, it's signed by a
Yeah, I see the
person, you
name.
see the name. And frankly, that was another initiative PCAOB had to disclose the names of the engagement partners. And I think when you see that engagement, I'd love to see that engagement partner on another audit because, I mean, I just see how robust it is. But, when you think about the cost, one thing I would encourage is you've also got to think about the benefits. And I think those benefits, obviously investors benefit from understanding more, but that has a capital market benefit. PCAOB's done a lot of economic studies on the spillover effects of capital market benefits, both in the US and abroad. And that redounds to a benefit to the company as well. The companies won't say that management in that tense meeting will say, this is not going to be beneficial for me, but this will benefit companies.
I would not want to be the investor relations person at Glenn.
Yeah, of course. But it helps companies to have really, resilient capital markets that have good reporting.
We're on the same page.
As you
here.
know.
Can I just chime in on the cost too, Sam? We did in the release in connection with the audit reporting model and CAMS, when we put that out, we said, and this was based upon work done by the Economic Research Group at the PCAOB, there was not an expectation of significant additional cost because of CAMS, because they were all, probably everything that was in that document that Sam just read was probably exactly or about exactly the same as the auditors wrote to the audit committee. So the CAM is a subset of what was in the audit committee report. The cost would be the discussion with the management in the audit committee about the report maybe at that time, but not from the derivation of the items. They emerge from the audit and from what's written in the audit committee report.
We're on the same page, but I'd be curious as to how they couched that discussion if you asked the question. So.
Yeah.
Jack, you had a question?
Just to chime in on the cost part, I think there's a different contingent cost that we're not thinking about when you're talking about U.S. versus Europe. You may have the same, essentially the same standard for CAMS as CAMS, KMs, and you have the subset already developed during the audit committee meeting. But I think, Sam, you were the one that said it, there's a level of specificity that's a choice.
Mm-hmm.
So the United States has a much more litigious kind of environment. So the more you say, the more you might be in danger of getting sued for. Whereas you don't really have that kind of environment in Europe. And that might be why you have a dual listed company and one set of CAMs looks very different than the other because they're going to choose to say less so that there's less risk for them.
Yeah, I hear that. I mean, I do hear that. I think we heard that when we were developing the standard. I don't know what to make of it. There aren't cases out there.
I'm not saying
backing
that it
up.
solves it.
I can't
I'm
say
just
there are
saying
cases
that's
that go
why.
the other way. I think it will take a long time for this to play out. As an attorney myself, I think, in companies, this is the way it works for companies, providing disclosure is the best way to protect yourself from liability. So, I mean, the more disclosure an auditor provides, I think if there is a problem, I mean, you obviously shouldn't disclose something that's not right. I don't think any of these auditors are doing that. But the more disclosure you provide, I think, will help the auditor if something goes south. But, these cases haven't played out. I don't think we can actually say that it's litigation that's driving this. Also, I'll note, there's a lot of litigation going on in Europe especially, and that's where these are.
Particularly on things like taxes, right?
Yeah, there's a lot of litigation, a lot of liability for board members, and it's becoming much more.
We did a study on we looked at them after CAMs after they were initially adopted, and we saw too that dual listed companies took out CAMs, and to me, it's already out there. Like, if you're going to get sued in the U.S., they're going to pull that up and say, well, you've intentionally omitted something, right? Does that not look worse, right? Mm-hmm. What I liked about the illustration that Sam has is back to the original point of they're dealing with some very contemporary issues, taxes, laws. NOCLAR under the IAASB standards.
Investigations. This company was under investigation.
Right.
So the auditor still wrote a big, robust report with all that going on.
And climate, for example. So for me, and I thought Marty's comment was particularly interesting of seeing an insurance company. My background is insurance. Insurance companies know that and auditors of insurance companies know there's massive amounts of estimates, right? And they can be larger than income, as Marty pointed out, right? And so it's really the comfortability with understanding that most of what's in the financial statements is not a point. It is a point estimate. It is, and the range could be very wide. And I do believe that's because they perceive it to be, auditors perceive it to be protective, just having been on both sides of that insurance audit. So anyway, if we don't have any more questions, or let's move to Jared. Oh, is there? Oh, I'm sorry. David?
Yeah, it would just be on the CCAMs and the KCAM. That if you ask the auditors, why are they different? Yeah, they will go back and say the wording of CCAMs and KCAMs is different. But I think there's something more here, and I would worry a little bit that in the United States, the notion that you only do what you absolutely must have to do is what is done on an audit. And that on the key audit matters in the States, outside of the States, it's been interpreted much closer to a principle-based set of accounts, where we're trying to tell the investors these were the really key issues and judgments that we needed to make. And there may be something that needs to be done in terms of writing what is a CCAM and what's a KCAM, but I almost wonder and worry a little bit for the States that there's a mindset here that isn't terribly helpful.
Okay. Jared, over to you.
Great, thank you. The big question I was asked to answer are these CAMs decision useful information? And I would say for the vast majority of them, they are. The two indicators I would look for is it helping me get good information, or is it helping me ask better questions? And that is happening. We're finally having a conversation with an auditor, even though it's limited. But it's a start. So that's a good place to start off from. But they aren't living up to the expectations that we had hoped for the robustness of disclosure. They tend to be written in a very legalese methodology. It's a kind of a negative connotation, similar to the risk section of the MD&A versus an opportunity for the auditors to talk to us, to tell us what they're doing. Their job is very important and to provide more disclosure. When we first started advocating for CAMs with my organization, our hopes were that CAMs could help reduce the investors' expectation gaps, help educate investors, because there's a lot of misinformation among investors and a lack of knowledge, and then overall improve audit quality. So we saw a lot of potential benefits from the CAMs. Our idea was that the CAMs would originally come out, provide new information for investors, start them talking to management, asking new questions, which ultimately feed into the audit committee, which would help ultimately feed to the auditors and help lead them understand where the misstatement risks are biggest, and there would be this information loop, and then there would be better KCAM or CCAMs coming out. But that virtuous circle that we'd hoped for hasn't really occurred. Over the last couple of years, as CAMs have come out, I've seen 2 examples of internal or external research reports actually mentioning the CAMs. Ironically, one of them was from an ex-CPA. So they really haven't really fed into the broader investor community as much as we had hoped. Also, I've had hundreds of group meetings with other investors. I've never once seen a CAM question come up. So it really isn't stoking up that conversation that we had hoped for. So I think. So it's a good start. We're getting new information, we're having a communication, but that disclosure needs to improve from our perspective to get other investors drawn into audit. Audit is a very important part of the process, and I don't think most the broad investor community truly understands that, and this is an opportunity for them to get involved and start communicating with the ultimate auditors.
Can I ask you a question, Jared? And this is sort of unfair because I didn't ask it to you before, but are you, one of the questions, it occurred to me, that came up when CAMs first came out is whether investors were actually going to talk to management about the CAMs or whether they were going to talk to the auditors about the CAMs. And what I hear you saying is you're talking to management about the CAMs, not the auditors about the CAMs. I don't know if investors are actually talking to the auditors.
I've never had an opportunity to talk to an auditor of a firm that I've talked to auditors of other firms, but as a firm that I directly invest to, I have no communication with the auditors. Even the audit committee, I would love to. I've had one opportunity in my experience to talk to a non-management committee member or audit committee member. Even that communication line. So we are so far away from the auditors. So and we got no information. So now at least we have some information. But no, I haven't had an opportunity to talk to my companies that I invest in, to their auditors. Speaking with other auditors, there's this negative connotation to CAMs. I think that's a big issue. They see them as negatives, so less is more. And my my conversations with management teams, it's the same thing. Like a CAM has been highlighted as a bad thing, so we want less of these. We want less verbiage. That's a big problem. Where it isn't this disclosure opportunity that we had hoped for, where they're giving us more information, they're teaching us, we're learning from it. To Hale's question or comment, this was an opportunity to really kind of build up the investors' knowledge of the space.
You know, one of the things that also came up at the time I remember discussing at the SAG was that discussing with the audit firms that in fact their audit opinion was now going to be contextualized with the things that investors thought were most important, right? And some people pushed back and said, well, these are the things that the auditors think are the most challenging to audit and that the auditors think are important. And I was like, well, the auditors are supposed to be looking out for investors' interests, right? So there's got to be some overlap there, right? And I'm just wondering if, if that is happening. I think that evaluating the sufficiency of the number of CAMs really comes to investors saying, well, we have all these other issues about the company. How are these not landing here? But I'll let Colleen go on. It was just a question that came up. I remember discussing with the auditors at the time at a SAG meeting. It was, you can think this, but the world's written a lot about this company, and how are you meshing what the investment community has said about the company with what's actually showing up in the audit report? Because they're going to do that reconciliation to some degree. Anyway.
One of the reasons for CAMS, of course, was what Jared said. He doesn't talk to the auditors. There is no opportunity to talk for the investor to talk to the auditors. So the only opportunity, therefore, was improve the audit report. And so the auditor can talk to the investors and tell the investors, here's what I did as part of that $25 million audit that you paid me for, and the complex things that I dealt with as part of that very complex, challenging audit. So, I mean, the only other opportunity in theory an investor would have would be at an annual shareholders meeting, maybe at the reappointment, to ask questions of an auditor, but
I think there's
very little chances for opportunity.
No, agreed. In Europe, though, I've been on some committees where people have said they've talked with audit committee chairs is different in the sense of those discussions with audit committee chairs about CAMs. But anyway, in different jurisdictions. So let's go on to Colleen.
I see their question. Should I?
Oh, I'm sorry.
Okay.
Did you?
Just, Jared, one quick question. In terms of investor relations, how often do you bring CAMs up on your specific portfolio companies?
I would, for me, it's quite a bit because I've been involved in CAMs for a while, so I don't know if I'm a fair survey point. I would say other investors is probably pretty rare, but I would say that if we're asking questions to management, if we're asking questions to IR, it's going to get back to the auditors, and you're going to hope to see better. So, we do have an influence, and it's channeled through management, but it's not happening right now.
I think that would be one area for the PCAOB to really look into, is how often IRs get the questions, in part because the pushback when the PCAOB says, we think we need to do more, the response, well, we never get any questions. The investors never ask us, so therefore it's not relevant.
Yeah, I mean, it goes back to that virtuous loop
exactly.
idea that there
No, I
wasn't
thought
anything good to talk about,
phrased
wasn't
it
much
well.
to talk about, so it didn't really get that big bang of attention.
Did you have a question?
Well,
Yeah, I just wanted to add a little bit to that, the virtuous circle comment that Jared, I'm going to start calling him the CAM geek at work. So yeah, I guess to underscore his point, I do believe that there is a lack of knowledge of what CAMs do offer investors, especially in the U.S. investor base. That said, I think if we increase the relevance of CAMs, there would be much more interest. As it relates to the virtuous circle, we can meet with the CFO of a company or IR, depending on our size as a shareholder within that company, probably, and ask questions. And those questions, I think, would ultimately find themselves in MD&A or some aspect of the financial reports. I can, I have my own experience as the CIO of a large pension fund where people at the legislature will ask multiple questions. Next year, we put it in MD&A, and it may rise to an audit review of that, and there's no CAMs in GASB, so we don't have those disclosures within our financials. But I certainly do believe the companies that we invest in are interested in what we're looking at and how we're perceiving the company, and they would increase disclosures, which would then potentially be rise to a critical audit matter for the auditor. So that's I don't think that it is realistic to think that we could contact the auditors, as minority shareholders. If we're a 10% owner, they might allow us to contact the audit committee chair or the auditor, but it's just not realistic, I don't think.
Did you have a question?
Yeah. Just maybe a little bit of a comment too. So the perception that the financial statements are a key component of every investor is, I think, not foundational. I mean, if you're an index investor, the information in the financial reports is almost completely irrelevant. If you're an active investor, it's where you disagree with financial statements or you disagree with the interpretation of the market's evaluation of the financial statement that drives an active investment decision. I think that's basically what Jared works on.
Yes.
So, given that, I'm not so sure that the CAMS has all that much more impact than what is stated in the financial statements if in the mind of the investor, they disagree with the investment reporting. That's fundamentally what's going on with an active investor. And one of the problems, and I've been a CEO of a public company and an audit committee chair, you have regulation SD. If Jared called me and inquired, trying to get deeper past financial statement disclosures that we have made, including our risk disclosures, including our commentary, including what we agreed to allow the auditor to say, because at some point, there is a dynamic between an audit committee chair, a CEO, and an auditor. He would get a blank stare because we can't take Reg SD exposure. So this is kind of, there's so many matrixed influences on that communication that I find, you have to consider all those impacts. You can't just consider what the financial statement is saying and what CAMS says about the financial statement.
I agree, and I raised the question about talking with the auditor simply to highlight the fact that this is the only communication, right?
Yeah.
And that it is so important because it is the only communication. So it is the existence of those boundaries that puts pressure on the importance of it. That's what I'm trying to say. And we constantly have the conversation, and it's come up particularly in light of the banks, right? Because people say, oh, well, you can adjust the financial statements for things like fair value, or investors can do that. But most of these banks were owned passively, right? So you need an active investor doing that, talking about it, whatever, to bring that out. So I agree with you. Gina.
So I just want to underscore the point that Jared made on the fact that CAMs are seen as negative, that anything beyond the boilerplate is seen as negative by management more often than not. And that dynamic, I think, also keeps CAMs keeps them from coming to light. And the question that I have is, to what degree does this body have to hold auditors accountable? Because there are lots of places where they had to make judgments, but they simply didn't comment on them.
I agree, but it's challenging to hold them to account when you don't talk to them, right? Or they're passive, right? That's the.
Gina,
I'm saying this body.
No,
you were asking from an enforcement standpoint.
Enforcement.
Yes.
Okay.
We'll get to that.
Okay.
We'll get to that. Oh, yes. I can't tell who that is.
Gary. Oh, Gary.
We have a question on Zoom?
Yes, this is Gary. I just wanted to add, I'm sorry that I'm not there in person. I really miss being there. But I wanted to interject. I think the CAMs are a major step forward in access to what auditors are thinking about. But I don't think they're getting the traction that they deserve, and I think it's because of access. We are an active investor, and we've got 15 individual analysts. And the only one that had even heard about the CAMs happened to be a CPA. So I don't think there's an awareness out there that CAMs even exist. And part of the reason is that they're very difficult to find. On Bloomberg, I can go and I can find 1,600 different ESG factors, but you can't find the audit report or CAMs. And so I know Bloomberg isn't the only source of information, but I think that there needs to be an effort to make the audit report, including the CAMs, more accessible.
I think that's a valid point about where investors get information, right? I think that's a valid point that not all auditors or even companies understand, is that they're not printing it out and flipping for that page. They're going to data providers.
The technology committee has noted that.
Yeah.
I would also note that we're herd animals, so we start hearing other people talk about it. It will have this compounding effect. You hear other people start talking about it, it will become a bigger focus. So they just need that kind of spark of excitement. One opportunity is looking back at CAMs that, there's a firm in life sciences having revenue recognition issues right now. I looked at their CAM, it wasn't mentioned. That's the type of an exciting thing for investors, like this auditor missed it. It's a huge issue. And people are going to be able to look back at, or enforcement as well, can look back at, so now that they're out there, hopefully, some situations like that could really
Right,
spark.
that's the contextualization that we talked about before. Why is it not there? Yeah.
To Marty's point earlier about the education cycle on that other board that exists in Connecticut, one of the reasons that we spent so much time with the sell-side analyst is for exactly what Jarrett was saying, is you can get the sell side to talk about it, it then creates a discussion, and it certainly worked on credit losses, CECL, and other standards, but if they understand what information is available and they can get a competitive advantage, they'll start talking about it, and then that creates its own life cycle.
But to Gina's point, what this group can do is there are current issues and we've looked across these CAMs and we don't see them. Why is that? Asking that question in a way that gets more publicized in the media. So anyway, Jeff.
Thanks, Andy. One thing I thought about during this discussion is there's a lot of discussion about the use of the CAMs for investment decision-making, but a big part of the CAMs was information to help investors with respect to voting. It was voting with respect to ratification of the auditor, which is an annual vote at many companies, and it's also voting on the chair and the members of the audit committee. That was an important reason for the CAMs, was its use. That information could be used for voting, where there's very little information today in how to evaluate either the ratification vote or the chair and members of the audit committee. Thank you.
I think the chair and members point is a good one. I should have pointed that out at the beginning. Thank you for that. Jack?
I think we have a little bit of a chicken and the egg problem, which one comes first. People don't use them because there aren't many. There aren't many requests for information about them at the investor relations level because nobody notices them and they don't push them. The companies don't push them. So if we could somehow get the enrichment of quantity, then there'd be more adoption of them by the herd animals.
But quantity without education, you've got to link those two together. And that's back to my question about Marty and what plan did the PCAOB have initially about educating the population.
Did I get all the questions? Oh, Colleen. Right, you're next.
Okay. So thank you all for inviting me here today. For those of you guys who I've not actually met in person before, I certainly know your names, and so it's lovely to actually meet all of you guys. So thank you very much. I want to start off, and first I'll give just a couple quick highlights from the December 2022 excellent interim review from the PCAOB that you guys are probably all familiar with, and that has been referenced before. But if you'd like to go to the next slide. So first, as already mentioned, the average number of CAMs per audit report has declined over time from 1.69 to 1.43 from year 1 to year 3 for large accelerated filers. The proportion of audit reports that communicate a single CAM has increased. So it went from, I think it was 49% to 65%. And then I think most kind of interesting to me was in this investor survey, less than half of the investor respondents thought that CAMs were easy to understand, 44%, and tailored to the audit, 40%. So you only have 40% of the investors who responded to the survey actually said that they were tailored to the audit. Now, one reason for that, if you go to the next slide, is that, or one possible explanation for that, I should say, is that CAMs are pretty sticky. So the most commonly communicated CAMs are pretty consistent from year to year. So the top, this is figure 2 actually from the PCAOB's own interim review. And they show that the top 5 most communicated CAMs for large accelerated filers have been consistent in each of the past 3 years. So there's a very high correlation within company. So if like a company has a
revenue rec cam in 1 year, they're probably going to have a revenue rec cam in the next year. There's academic work where they try to predict out what the cams are going to look like, and you can do so, pretty well. So now if we get into more of the traditional academic research. So we have, it's hard to do some of the traditional accounting work on this because we're looking at sort of big N samples. We're limited to only like what is reported. And a lot of times we're trying to look for big important questions like, abnormal returns or abnormal trading volume, earnings persistence, financial reporting quality, these kind of big conceptual things that can be really difficult to actually implement as a proxy. So, the majority of the academic studies don't actually find, on average, that CAMs provide incremental information to investors. But again, I'll discuss there are some limitations. This is a hard question to study. But what is interesting is that they do actually find that CAMs can be informative in certain situations. So you have a company where, say, they have high short interest, or they've just met earnings, or there's some reason to think that, they're a little bit marginal, then there's some evidence that CAMs can be more helpful in those situations. So, and something that was interesting and I think relates to the conversation that we've had here is that when people first started studying CAMs a couple of years ago, there were a couple of studies that came out that found actually the number of CAMs, just purely a number, was correlated with both litigation risk and also was correlated with poor financial reporting quality. So now this result seems to have gone away. And presumably it's gone away because we've now standardized the number of CAMs, and if everybody has 1 or 2 CAMs, you're not getting the variation that you would need to actually find results here. But given that the studies that did find this, came out earlier, and perhaps this is reflective of what people thought when they read this financials at the beginning, you see somebody with 6 CAMs, and people started to get a little bit worried. And perhaps that's kind of created that feedback loop. Now, there's also a number of experimental studies, and some of these actually were out even before the PCAOB's CAM rule came out. And when I read the experimental work and compare it to the empirical work, there seems to be somewhat of a disconnect, because when you're looking at the experimental work, actually a lot of it finds results and finds that, if you give these hypothetical investors a standard audit report or an audit report with CAMs, that they use the CAMs and that it actually impacts their investment decision on average. Yet when we see the empirical work, we're not really seeing that. So the question then begs, what's going on? What is this causing this disconnect? And there's of course lots of reasons for why we could have that. But some of the experimental work is perhaps not terribly reflective. It's like 0 CAMs or 1 CAM. Some of it too, though, is perhaps just the CAMs are not being as implemented or not as tailored and not as well done as what we would like, and that if they were, this idea works, but perhaps not in the current situation. Some other fun facts from academic literature that I just wanted to highlight. So investors raise issues noted in CAMs and earnings calls. There was one paper that did actually find this. So this was a fun one too. So when they look at the disclosures in footnotes and look to see how they relate to issues in CAMs, well, you find that the disclosures and footnotes from management have been supplemented and are more detailed when there's a CAM. So it looks like, that when managers expect something to be more scrutinized, they add more disclosure to it. And this also has come out in law firm memos too, where law firms have suggested that their clients do this. So, perhaps there was a benefit. There's also that they look at investor returns following an M&A announcement, and you find lower returns to that M&A announcement when there has previously been a CAM, questioning the M&A. So, and then actually one of the studies that Sam mentioned, for a small sample, there are the firms that report both CCAMs and KCAMs. There is a study that went through and actually compared those. And, as Sam had mentioned, they find more KCAMs. They also find that that the KCAMs are longer. Now, they find in this study that they don't have any sort of impact on the earnings persistence of the two companies. It's a result that's a little bit hard to interpret, and I think the idea of earnings persistence is a little hard to capture empirically, so I'm not sure how seriously we should really take that finding. But certainly the descriptive findings that they're more KCAMs and that they're longer, is consistent with what others have said and found. Now, as I mentioned, there are limitations in academic research. And I know from, Hal's question earlier where he's like, oh, are there case studies where we can sort of explain why this one is so detailed? Sorry, not so much. Now,
I'm shocked. I'm shocked.
accounting research in general, especially, is more economics-based. It's large N. It is looking at concepts that are difficult to capture, and it's a little bit less case study based than say law, where many of us are lawyers. We love case studies. That said, there was one study which looked at CCAMs and auditor turnover, and found that the CCAMs do actually change when you have auditor turnover. So certainly the audit partner in charge is one factor, but not going to be the only factor. But in general, so it's difficult for us, to measure some of these concepts. Some limitations. First, the CAMs that we see are all we have. And we just have to kind of assume that this is a whole set of CAMs. And, this is quite an assumption. So this is one concern that we have. Another, when we're looking at proxies, abnormal stock returns, abnormal trading volume, financial reporting quality. These are hard to measure, and there are a lot of things that affect them. And when you have the CAM is coming out as part of the audit annual report, well, lots of things are coming out. Hard to really know how much the CAM versus all the other information that's being disclosed. And then also one other limitation too that I think comes out when you do just purely empirical work is, well, we see results based on what we have now, but one question that I'm guessing you guys have is well, if we change this, what will be the outcome? And empirical work, can tell us there's sort of limited amounts that we can learn from empirical work, because we just have to study things as it exists right now, and unless we have another setting where we can actually discuss and study that proposed outcome, it's hard for us to do so. For me personally, I think some of the critical limitations of the academic work have really been, something that Sandy mentioned, which is, do CAMs really capture what investors actually care about? And do CAMs actually represent the full set of information that should be disclosed? So we haven't had a lot of work on that, and I think it's, hopefully somewhere the literature is going to go. I will note two quick, sort of inquiries along those lines. So first, to better understand whether CAMs that are disclosed actually represent the issues that investors care about. So I pulled these short reports, all short reports from Money Wonders and Hindenburg over the past year. And obviously, short sellers are not a perfect representation of what investors care about. Certainly within academia, many people hate them. Yet, they are one representation. And so I looked at all of the information that they have, all the accounting, and it's hard to define exactly what is an accounting or an auditing issue, but looked at everything that they highlight for these companies. And then I compared that to the CAMs for these companies. There was zero overlap, not one. So, of course, the short seller reports are an imperfect proxy. I'm aware of that, and I wouldn't try to suggest that we should have 100% overlap. Obviously, that's never going to happen. It wouldn't make sense. But the fact that there was zero overlap, I think, raises some questions. Another place where I thought that CAMs might be really helpful and might be really good for investors are firms that are sort of marginal, firms that are perhaps on the verge of bankruptcy. And this was, as you can guess, inspired by SVB, and all of the articles about that. So I looked at the all firms that filed for bankruptcy, all public companies that filed for bankruptcy in Q1 2023. And there were 65 public companies, and so I pulled the CAMs from the most recent audit report for those companies. Two key points. First, only 20 actually had CAMs. So this was the most striking thing for me. Well, yeah, they're not informative if you don't have it. And most of these were actually EGCs, so, hence. But still, the fact that there are only 20 that had them was striking for me. The second thing that I think was very striking for me is that there was clearly confusion between what is a CAM, what is a going concern opinion, and how do these overlap, and how should we integrate them. So it was clear that even the auditors didn't know what it should look like. So if you look at what those CAMs actually are, the most common one is going to be impairment of goodwills or other intangibles. But going concern was this number 2. And there were, some of the ones that did not have CAMs would have like going concern language, and, it almost seemed like they thought the going concern language was the CAM, or just by having the CAM of a going concern, then they didn't need going concern language. It just was very confusing. And so to the degree that that can be clarified, I'm guessing would be helpful. Finally, so this is all I had. I will end, though, with a quick joke that I tell my students on day one of accounting, which actually the interaction between Martin and Hal reminded me of earlier. So I showed them a balance sheet. This is like our class first slide. And I told them there's one number on here that we know is correct, and see if anyone gets it. And actually, they usually do. Yeah, it's the date. And yeah, actually, they usually get it. So.
I've seen that wrong, too. So.
Yeah.
Quality control reviews. Yeah. May I ask a
Yes,
question
please.
on that? Okay. There was an article in the Wall Street Journal on June 1st, profit numbers get spruced up as business slows. The subtitle was, business may be slowing, but measures of earnings management are rising. What caught my attention was your slide that had the average line item, or average CAMs, was actually on the decline. What struck me about that is when that other board looked at segment reporting, they saw a similar pattern. Over time, the number of segments disclosed also declined. Less information. What I'm trying to understand, and curious as to whether there's been any research on this, is mapping earnings management statistics, and the article cites one in particular from an Indiana University professor. There's an increase in earnings management, and that tends to peak right before a recession. Okay, so maybe, Sandy, we do get that recession.
Yeah, maybe.
But mapping against the CAMs, which are actually on the decline. So we're going in opposite directions. So it seems like a ripe territory for academic research. Have you seen anything like that?
That's a really interesting question. So the only stuff that I've seen, again, because it's so hard for us to really examine the CAMs, have been those studies that look at just the number of CAMs in financial reporting. And those, the ones that found stuff were, and those, when they say financial reporting quality, they sort of mean earnings management. So they did find more CAMs equaled more earnings management in like 2019. I haven't seen anything recently, and I think it's just been difficult for academics because there's not enough variation in CAMs. And if you only have one or two, and 65% of companies have one, it's, unless you're really digging into the language of those CAMs, which the work hasn't, to my knowledge, done that in earnings management yet, but it makes sense.
I've seen some length of, number of words, types of words used, yeah.
I think, though, you'd probably want the topics and that sort of thing, and I haven't seen anything that I thought was really well done along those lines. But it's a great question. I will look into it more.
One thing that we did at CFA Institute is when the CAMs first came out, we looked at the CAMs, and a lot of people did the topics, like is listed here, and we compared those topics with what the Big Four said are the top 10 items that the SEC asked comments about, and there was an overlap except for segment disclosures, which I really, and I believe, just my personal opinion, that because of the importance of segment disclosures to investors, that accountants don't necessarily appreciate in the same way. I didn't. And also all of the significant judgments between, the allocations and the decision about what are segments. It's surprising to me that it is almost never a CAM. I think I've seen it once when Duluth Trading went from 2 to 1 segment, right? And that was considered more CAM necessary than others. But I think that, I mean, as I hear what some of what Colleen is saying, is it's really, and to Gina's point, is one of the things, and we'll move into that next based on the time we have, is what do we need to do? What do we need to do, and what does the PCAOB and maybe the firms need to do? But one of the things I think we need to do is look at all of the things that exist out there as issues that are discussed about a company. I mean, short sellers are just sort of the extreme of it, right? But it's the same thing, and saying, well, why aren't these CAMs, right? Maybe we have to start the circle, the virtuous circle, if you will, of saying these are out there, and why would you expect to see this, and report or do research on that? Yeah, go ahead.
I also want to make one comment on a line of academic study that wasn't mentioned in Colleen's excellent overview of academic studies, which is the role that gender plays in CAMs and the length of CAMs. And there's at least one study in the UK that shows that gender plays a significant role in the number of CAMs and also the detail of KCAMs. And
Gender of the audit partner or gender of the audit committee chair?
the gender of the audit engagement partner, but I would be curious to see that extended to the CEO and the audit chair.
We could actually do that because we've looked at the gender of the auditor, and we could compare that to the number of CAMs at least in the U.S. Anyway. Oh, sorry. You're right next to me. I'm not looking in your direction.
That's the problem with two Sandys.
I know, right?
Actually, Colleen, really interesting work. I was going to ask Samantha about Glencore and the incidence of CAMs. Is it mostly emerging accounting issues that are driving CAMs as companies ramp up? That's been my experience as an audit committee chair. This suggests it's persistent accounting. Do you have any analysis on whether it's emerging issues that are driving the CAMs or persistent accounting issues? And does that explain the deterioration in the number of CAMs? I'm just trying to understand that a little bit better.
That's really interesting. So I think the majority of CAMs are going to be just sticky, right? But then they do the studies. So now the academic work, if you're doing work on CAM, you do like unexpected CAMs, which is basically you model out what you think the CAMs are going to look like, and then you look to see, is there anything that we didn't anticipate? And actually, there are some studies that look at that and financial reporting quality or abnormal returns and try to see, is it an unexpected CAM, going to, do we see impacts from that? And that's the closest thing that I can imagine, but the majority of them are not unexpected. So there would be some of those unexpected that might be an emerging issue, but the majority of them are going to be those kind of persistent, sticky ones.
Established, no.
Yeah.
You know what's really interesting too when I look at your list there is that most of the CAMs seem like they're about recognition and measurement and not about disclosure. And that the CAMs are supposed to apply to disclosures as well, because most of them on the list and that I've seen are related to the actual recognition and measurement.
I think these are atypical just because of the marginal nature of the companies. Because, it was a weird list to me, too.
Okay. Okay, Jack. And,
Can I just ask one more question of Colleen? I'm sorry.
No, it's
I'm
all right.
sorry. So, the difference between experimental and empirical results, I'm kind of interested in that. Does that connect to, I mean, I've experienced problems where proxy oversight desires of my institution don't square with the Edgarization of the data. They don't want to read the document.
Yeah.
They want it on the screen, source from Edgar document. Is that impacting this difference?
I would imagine. I mean, we can think of lots of reasons of like people are just not reading it, they're not useful, they're boilerplate, or not boilerplate, but they're expected. But that makes a lot of sense to me.
Thank you.
Okay, we got to get to the recommendations,
Okay.
but
Just
go ahead quick.
minor observation, I was kind of surprised when you said that of the 65 companies, only had 20 were CAMs. Most of the others were EGCs. But if EGCs were required to have CAMs, I think we'd see that number of average CAMs go way up. All the studies show that the weakness in internal controls are at the lower end of the food chain when it talks about market cap. But I don't see how we can actually adopt, I think that would have to be congressional action to modify the Jobs Act. But anyway, missed opportunity.
Quick.
Thank you, Sandy. Marty mentioned earlier in his comments a recent academic paper. It's by professors at University of Wisconsin and at University of Houston, where they interviewed over 30 audit partners, directors, and senior managers on the implementation of CAMs. I thought it was a really interesting paper. There's at least three conclusions that I'm curious, Professor, what you think of, whether you agree or disagree with these three conclusions in the paper. The first was that the critical audit matter standard has potential to dramatically increase audit reports' usefulness. The second was auditor implementation of AS 3101 was inconsistent with the PCAOB's intent. And the third, which I thought was also very interesting, said it is unlikely that the PCAOB can realign auditors' CAM practices with the spirit of AS 3101 through inspections alone, as the PCAOB's 2020 inspection findings do not highlight an overarching issue with auditors' CAM practices, but specific instances in which engagement teams failed to execute those practices correctly. So I wonder your thoughts, any of the panelists, on those three conclusions. Do you agree with them, disagree with them? Your thoughts?
I think this is a really good segue into sort of some of the recommendations, Marty, because I think you were, one of those was related to the inspection. So
Yeah, so let's
I'll let
go,
both of you take it.
turn
but-
back to slide 17, if you will. So I think it's a really good question, Jeff, and I, for one, think I agree with those conclusions broadly, except for the fact about PCAOB inspections, so I'll talk about that. I'll just tee these things up and ask others to comment on the panel or elsewhere about how to improve CAM reporting, because I think there's been a general agreement around this table that, you know, right now it's not meeting the expectations of investors and the 1 or 2 CAMs per audit. I think the first is to the encouragement by the PCAOB, and maybe right through here, to the audit profession itself. I mean, CAMs, the audit reporting model emerged out of a time where post the financial crisis that changes were happening to the audit profession worldwide. Auditor rotation went in many countries around the world. Expanded auditor reporting was demanded in many countries around the world. And we looked at it as well in the United States, how to improve auditing and how to improve the role and relevance of the auditor and ensure that role and relevance was critically important. And so the audit profession had, in my opinion, an opportunity here with CAMs to really serve investors better by taking advantage of the additional audit report, by putting into the audit report substantive critical audit matters, and meeting and achieving the goal of meeting the objectives and the needs of investors for greater information about the audit. So I think the first step here to improve audit reporting is to go to is for the audit profession itself to look at itself, each audit firm to look at itself and saying, are we really achieving the spirit of what was in this standard? Maybe we're living okay with the rule of what it says and the words we managed to get around with one CAM by looking at the word especially or whatever it might be. But are we living with the spirit of this? And are we benefiting from this by having investors say, yeah, what the auditor does, we value their opinion, but they could be far more relevant to us. So that's the profession itself. Secondly, PCAOB inspections. I don't know to what extent PCAOB inspections have focused on this, but certainly inspections has all the tools they need to really take a hard look at CAMs. You know, the inspections could obtain from each major audit firm for a large selection of audits. All communications to the audit committee, the auditor's assessment of risks of material misstatement, you know, all memoranda on exam, the audit completion file, work done by specialists, all consultations with national office, the documentation regarding non-disclosure of CAMs. Why did we think that these 10 matters that we rose to the level of materiality to the audit committee, why none of those 10 matters got disclosed as CAMs? So I think there's the ability for inspections to really take a hard look there. If they have, then my comment on this would be, if inspections thinks that the firms are complying with the existing standard and inspections work so that merely focused on this, didn't say, yeah, we have a lot of findings to improve reporting and the number of CAMs, then I think the third one would be looking to modify the CAM language in the standard and amend the rule to achieve the objective of this, of providing useful information to investors. Just the language on the next slide is the language, just so you all know it, from KCAMs. You know, that was different definition, but expectations were that the two standards would result in largely similar results. The IAASB and the PCAOB worked largely together, many meetings together to talk about it, looked at each other's releases. And the definition, a little different, those matters that in the auditor's professional judgment were of most significance in the audit of the financial statements selected from those matters communicated to the audit committee. So, we actually chose not to use most significance because we were concerned that most would be one or two, and went to a different word, especially challenging, subjective, complex. I think maybe there are a couple more matters in KCAMs, but it isn't a lot. It's not like there's 6 or 7 as you have on that one report you had, Sam, or how many CAMs there were. There's maybe 2 or so, 3 or more KCAMs, one more there than there are in CCAMs. So some language I looked at here would be for the PCAOB to think about is the next slide, that critical audit matters are defined as those matters arising from the audit of the financial statements that were communicated to the audit committee and that relate to accounts or disclosures that are material and were the more challenging, subjective, or complex matters addressed in the audit. I think that's the spirit of what the current standard is intended to say anyway, that what were the more challenging matters. And so maybe the PCAOB has to look at that language and say, what is inhibiting the number of CAMs from meeting the expectation of investors of providing useful information? We hope that after this came out, this would achieve the expectations of investors, and that investors, when they looked at a 10K, the first thing they'd turn to would be the audit report, and there'd be a little bit of a roadmap in there as to what the more challenging matters were for the auditor that they had to address, and that's what they would just look at in terms of their conversations with management. So those are some thoughts on improvements, and eager to have the views of others.
So that's for the auditor and for the profession, but from an academic and investor perspective, what do you think we could do to move these forward? And then I'll come back to you, and then I'll get to David. Oh, he took his hand down. Running out of time.
I would say, investors are herd animals, so are corporations. If you could, you could do what the UK did and FRC and come up with, they let off their KCAMs with really good examples of like leading companies. I think if, we're past the point of CCAMs being initiated, but if we could find a partner, somebody that's a good actor, disclose well, I think other firms will follow in suit. So I think that's maybe one way to approach this issue. If we see, if investors see like, wow, this is really good, especially if you're a US only investor and you're not seeing these KCAMs, you don't know what you're missing. So that one thing you could do. I also would recommend engaging with the corporate governance, I think it's been mentioned before, data providers. If this became a part of their scoring factor, it would certainly encourage management, which would in turn feed down to the auditors. That's another aspect. So I think those are 2 improvements you can make to try to get this to move forward. I do think based on my conversations with auditors and management, the definition is somewhat problematic as they're hiding behind the especially. If you look at the KCAM definition, it's the most. Everything's got the most. Not everything's got especially. So I would recommend taking other actions like enforcement before you change the definition, because there will be claims of regulatory creep. But if other actions aren't working, you might have to change the definition.
So Colleen.
I'll be very brief. I think I agree with everything that's been said, and there's tons of academic literature on the effects of enforcement broadly defined, like when they look at IFRS and the implementation in different countries, and you find that it's different depending on the enforcement regime of that specific country. So, the sort of language, the standard only goes so far, and tailoring it with the enforcement or inspection component seems, from the academic literature, to have a huge effect.
Same with them really quick, and then I'll get the 2 of you. Do you have anything to add?
Sure. I agree with what's been said. I agree with what's been said. First and foremost, though, this difference that we're seeing, I think we really do need some clarity. That I think the PCAOB could provide some clarity about if we're seeing something removed from a KCAM, it's not in a CCAM. I mean, there may be certain areas where you think that's appropriate, where a KCAM doesn't exist, but a CCAM does. But clarifying where those are and where those aren't, where those are just choices by auditors, I think would be very helpful, because it's very confusing to investors. And then I echo specifically what Jared said. I'm very troubled by what he said about the perception of that CAMs are negative. I think it's very important to reverse that. I love the idea of championing the good examples. Obviously, that's what I came here to do today. And I think, we probably need to do more of that to show that this is actually a good thing to have CAMs. And also, I really take Sandy Rich's point about indexing and Gary's point about Bloomberg. It's really got to be, they've got to get into the plumbing. And, I was only here about a month after the standard was approved. But one thing that Chairman Doty and I did do was actually go to, to Hal's point, I guess Hal's still here, was we went up to Wall Street and talked to a bunch of service providers and analysts and others to tell them about the new information that was coming out, both the CAMs and also we talked about, the engagement partner names are, we have this big database. And what we heard, we got a lot of it's a lot of layers of the onion you have to peel. Oh, we need big databases. Oh, but at the core of it was their clients are investors. So they needed to hear from their clients. They would build a product that would produce this kind of information if they heard from their clients that their clients wanted that kind of product and would pay for it. It's critically important that this information get into that plumbing system, but it's what it calls for is that clients who use data ask them to build those data sets. PCAOB has done a lot to make that easier, like, for example, the database on the engagement partners, which I think is a very important piece of these critical audit matters. But I think it's the market itself that has to start building that.
Great. Jeff, I'm going to give you the last word.
Thank you, Sandy. I would respectfully recommend that we do amend the requirement, and I would do it in two ways. The first is the one that Marty mentioned, with respect to the word especially. I've heard, including with discussions with the IAASB, that they've heard that the word especially is the word being used by U.S. auditors in limiting the number of CAMs compared to the K-CAMs. So Marty's recommendation would change that. That's consistent with the recommendation made in the IHE letter that Jack drafted just recently. And we have a similar recommendation, or essentially the same recommendation in CII's letter. But the second change, it gets more to the substance of the CAM itself, I think is far more important. I've fortunately been involved in these discussions since 2007 around this topic. And I think what many investors were pushing for during the development of the standard, which Marty, you touched on, what the auditor learned. Many investors, not just CII and myself, many investors were asking for this project to give information about what the auditor learned. And the two places where that shows up, the two categories disclosures that shows up, is in a note to paragraph 14. And that note talks about disclosure of an indication of the outcome of the audit procedures and a disclosure of key observations with respect to the matter. Those two disclosures were the types of disclosures that many investors were asking for during the long number of years this project was being developed. They're both in paragraph 14 in a note, but neither are required. And so what we've seen to date, that no CAMs include the two disclosures that many investors had asked for during the many years this project was developed. So my recommendation would be amend paragraph 14 to require the two disclosures that investors wanted this project to result in. Thank you.
Agreed. I think that good to go back to the original survey at the very beginning, that they wanted to know about those items. Well, I think that's all the questions, and I appreciate everyone, all your guys' great comments and time and everything in getting ready for this. I think that the one thing I take away from this, having, working for investors now and having been an audit partner and the like, is how really important that investors think the audit profession is and how they want the audit profession to be successful and provide the information that they need. But it's hard for investors to know what the auditors are doing. It's a credence good, as I think Colleen first introduced me to in a speech. We have nothing to evaluate the auditor's work on, and investors are the client of the audit firm. And so as we move even more to technology and mechanical auditing of historical transactions, these risks and uncertainties are particularly important, and it makes the focus of the audit on those and in the audit report, I mean, to my mind, particularly important. So hopefully we can take some of these recommendations and write something up for the PCAOB. Yeah.
Thank you, Sandy, and thank you to all the panelists. This was a really, really helpful discussion. I learned a ton, and it gave the board and everyone in this room a lot of food for thought. So with that, it's time for lunch. We'll be back in this room at 1:45 p.m. Sharp. Lunch is in the same room where breakfast was served, so please go ahead and help yourself. Thank you.